Thanks, George, for that kind introduction, and thanks to everybody out in the audience for sticking around here to listen to what we have to say today. We're very fortunate to have with us three titans of the logistics industry. To my immediate right is Renee Krug, who is the CEO of GlobalTranz, which is based in the Phoenix, Arizona area. And Renee has a long career in transportation, and over the last 18 months or so has been the CEO of GlobalTranz, done an absolutely spectacular job. It's been involved in 9 acquisitions, which has built GlobalTranz into a real powerhouse, and also has been involved in selling GlobalTranz twice, each to a different private equity fund. Most recently, a sale from Jordan Companies to Providence Equity. So very pleased to have Renee with us. To Renee's right is Doug Waggoner. Most people in the audience know Doug. Doug is the CEO of Echo Global Logistics, and Echo Global Logistics has done a whopping 22 M&A transactions during its existence. It is not a company that is owned by private equity. Instead, Echo is publicly traded under the ticker symbol on the NASDAQ, ECHO. So we're glad to have Doug with us. And then to Doug's right is Mark Yeager, who is working hand in hand with CI Capital to build a very exciting logistics company called Redwood Logistics, based up in Chicago. And it's been really fun to watch that company grow at a rapid clip. Mark has been involved in 5 acquisitions just in the last couple of years as Redwood Logistics has grown quite nicely. So why don't we dive right into the Q&A here and see what our panelists have to say. First question relates to the current M&A environment. Are you seeing a lot of attractive deals coming across your desk that have been put together by investment banks? And the other sort of corollary to that is, are you able to generate any proprietary deal flow by virtue of reaching out to companies that might be a good strategic fit with your businesses and perhaps generate some M&A activity in that way?
Sure. I'll go first. We are seeing a lot of deal flow. We're seeing it from investment bankers, but we're also seeing a lot of proprietary deals coming across our desk. And I think that's because we've been so active in the M&A market and have so many acquisitions that we've done in the past 24 months that we're starting to get a lot of inbound flow as well. So we have a lot of companies that have reached out to us asking if we're interested, and we're actually looking at multiple deals right now.
Yeah, in our case, nearly all of our 22 deals were sourced proprietary deals. You know, we've got an M&A person in-house. We work with some outside firms that help us do some lead generation. But even our largest acquisition, Command, was a deal that was the culmination of 4 years of relationship building. And actually, it was an idea that you gave me once upon a time. But you know, we find that the best deals are the ones that are based on mutual respect, culture, personalities, and a good business fit. And that's typically cultivated. It's not bid on in an auction.
So we've done 5 deals, as you mentioned, John, and we'll announce a 6th, actually, fairly soon. Small, tuck-in, but strategically important acquisition. We're about 50-50, right? So 3 of our deals have been sourced internally, and 3 of our deals have been sourced through the investment banking community. We've only been at this, 2 years, so it took us a while for the investment banking community to understand that we existed, right? And that we would do deals other than with Republic, who we like, but we've done our last 2 deals with them. So we certainly, I would echo Doug's comments, we would prefer to source our deals on a proprietary basis. At the same time, we're very receptive to deals that come through a conventional process.
And just to differentiate a little bit, Renee, you said that you have some inbound calls coming in from companies that have not engaged a banker but have been intrigued with what you're doing and are sort of saying, gosh, would you be interested in buying me? Did I understand that correctly?
Yeah, that's true. So, and it's a little bit of both. As Doug mentioned, we're busy cultivating relationships, getting out in the market, meeting people, understanding what they're interested in doing over the next couple of years. But we also have inbound, where they're calling us and saying, look, we know you're buying companies, we know a lot about GlobalTranz, and we'd be interested, if you'd be interested in buying us, we'd love to talk. Now, we did have one last week, and I'm going to pass it on over to Doug and DeMark. They were at a 15 to 17 multiple, and so we're going to send those your way. But yeah, we do have a lot of inbound.
Very good. Let's move on to another question and try and delve into what types of companies you're seeing. You know, when people use the term logistics, it can mean 100 different things to 100 different people. Are you seeing mostly truck brokers? Are you seeing LTL brokers, air freight, ocean freight, forwarders, freight tech companies perhaps? What does the deal flow look like, and has it changed at all over the last, say, 5 to 7 years? Mark, do you want to start out?
Yeah, I mean, I think to a certain extent you sort of catch what you're fishing for, right? So we wouldn't necessarily be aware of a lot in the international space because we're predominantly a North American company. So what we come across is, you know, quite a bit of activity in the freight brokerage space, no question, and we've seen a lot of deals in that space, obviously, over the course of the last couple of years. So high levels of activity there. And we're starting to see more in the tech front, which is a major area of, you know, what we see as ongoing investment for us. So those are starting to crop up, businesses that are now at a point where, you know, they want to take the next step and maybe don't have the funding necessary and don't see the venture capital markets as the best path for them forward. So we're seeing more and more on the tech side coming our way.
So brokerage companies typically trade on a multiple of earnings or EBITDA or cash flow. Some of those multiples have been, you know, high single digits, low double digits, occasionally mid to high teens. Some pretty rich multiples over the last couple of years, whereas the freight tech companies tend to trade at some multiple of recurring revenue.
Yes.
Okay, maybe a 6 or 7 or an 8 times recurring revenue. Is it possible to blend a company that fundamentally was formed around an EBITDA multiple concept or construct with companies that trade on multiples of revenue?
It's a challenge for us. We try to get, you know, to that balance that makes sense, you know, with the tech companies and what we really plan on doing with it. There's definitely a difference in East Coast and West Coast valuation expectations among tech companies. We are not generally in a position where we would want to pay a full multiple of revenue, right, as to what's going on in the marketplace. But so we do try to find sort of we want companies that are, you know, at least break even and hopefully profitable. So there is a baseline to work off of with EBITDA, but nonetheless it needs to be adjusted to take into account revenue for sure when you're talking to a pure tech play.
Yeah, and on our end, I would say we're, you know, a technology company ourselves. So we have 140 developers at any given time updating all of our software. So we feel like we have a great foundation of technology, and what we're really looking to do is add in a different mode that might be transformative to the business to give us something incremental to sell, or something right up the fairway that's additional customers that are already in our space that would be a tuck-in. But our technology, you know, we already have a great technology company. We continue to build upon that, so that's not something we're looking for.
Doug, have you seen anything different in the composition of the deals you're seeing? Or do you want to comment on how you fit in with the technology
I was going to
trend?
make a comment. Back in 2009 when we did our IPO, you know, Dave Menzel and I were preparing for our roadshow. And we used to say, hey, we're a technology company that happens to make money on freight. And that was, you know, when you do a road show, you develop a pitch and you go out and you meet with hundreds of investors over a couple of week period. And as you prepare for that, you meet with the sell side analysts that will eventually launch coverage on you. And they're trying to figure out your business and how your financial model works and what your story is. And in the early days, we would meet with all the tech investors, but we'd start throwing out terms like LTL and truckload, and they said, what's LTL again? And pretty soon they'd say, hey, we have a transport investor. Let's bring him in here. And over time, we got passed from the technology analyst to the transportation analyst. I think that brought down our multiple.
I'm sure that's true.
I'm sure.
Don't you also have a small, what I would call corporate venture capital kitty?
Yeah,
that
we
you can
make
deploy when you see interesting technologies?
We make small VC investments in companies that we think are interesting in the space. And we do it not because we're looking for an ROI, but we want a front row seat. And we want the opportunity to be, the first company to pilot with that technology and to potentially partnership with those companies if that opportunity exists.
Does either Redwood or GlobalTranz have a similar pocket of money to be used for seed investments?
We have a similar approach, probably smaller than Doug's, but and we have a similar philosophy too. We really want to use it primarily as a vehicle to stay current with what technology is emerging, as opposed to seeking a traditional return.
Yeah, and I would say that we are certainly looking at technology-based companies, but generally speaking, because we are tech forward, we're using that investment to continue to build out our own technology. That's where we're putting our money.
Yeah, Doug, you're the only CEO up here representing a public company, and I remember when I started on Wall Street, I don't know, gosh, 30, 35 years ago, it was sort of like the Wild West. Almost anything went. If the research analyst wanted to work with the bankers, that was okay. Now, if you did that, you essentially are fired. So the Chinese wall is 80 stories high, and it's not to be violated. When you're looking at various transactions, is being a public company an advantage, a disadvantage? What extra steps do you have to take in order to make sure that you've perhaps properly vetted the transactions?
It's interesting. I think traditionally public company valuations would be higher than private valuations, and which makes raising capital very easy. We can go to the market, overnight and sell equity and raise equity capital. It's pretty easy to arrange debt financing. In the current market, that's flipped. We see private company valuation are actually trading at a higher multiple than public companies. So when that's the case, you're kind of hesitant to use your equity as currency. And on the debt side of the house, whereas a private equity firm might use 5 or 6 times leverage against EBITDA, as a public company, your investors aren't going to be very happy if you go into leverage that's greater than 3. So you have to think a little bit differently about how you finance it. And then I think the second part of the story is, if you think about the range of investors, you've got VC investors, private equity investors, and public equity investors. And that's the order in which they take risk. The VC guys will bet on anything. The private equity investors will bet on a sure thing. And the public equity investors won't bet on anything. And so what we find is they're very conservative. And when we're about to do a deal, first of all, we have to like the industrial logic. It has to make sense for us. It's got to be a good fit culturally and people-wise. But also, what's the story you're going to tell investors? Because if it doesn't make sense to them, you could announce the deal and tank your stock price. So we buy companies for the right reasons, but we have to be mindful of the story that we tell about that investment, because we want our investors to feel confident that it's a good strategic decision.
Interesting. Now, Renee and Mark don't have public investors to answer to, but they have very high quality private equity sponsors to answer to, and some people would say that's a little bit easier to have one group that you answer to, and usually it's easier to align your objectives and to get approval for transactions and so forth. Do you feel that because these private equity firms are relatively flush with capital, very sophisticated with respect to augmenting their equity with debt financing, and given that you have very large and growing platforms, does that give you a big advantage out there in the M&A marketplace? Because not only do you have the advantage of unlimited capital, you're trading at, as Doug said, a higher multiple, in theory at least, than the public companies are, plus you're able to make decisions and be more nimble, perhaps, in a public company. Is that something that really works to your advantage, do you think, out in the marketplace?
I think I would say that unlimited capital is an interesting term. We're excited. We've just sold to the Providence Equity Fund, and it's $40 billion under management, so certainly a very large fund. But our goal, of course, is to increase the value of our company and get a great return for our shareholders. So as Doug mentioned, we absolutely pay attention to the deals that we're doing. They need to make sense. One of the things that I'm excited about is the first three big ones that we did the following year either doubled or tripled in EBITDA. So we've done a nice job of picking the right companies, bringing them into the fold, integrating them in, and helping them to be part of the bigger GlobalTranz technology, which is a great part of our story. So we're thoughtful about the ones that we do. We have a strategy that is in line with our investors. We have either tuck-in, we have three ways that we go after acquisitions. One is it's a tuck-in, it's in the brokerage space, they do what we do. They can come into the fold of GlobalTranz and take advantage of our tier one grade LTL rates, our technology, our software, and our buying power. So we certainly have all those advantages. The second one would be something that's transformative. It's different than what we currently do today, and we're able to bring in a business with a different mode, and now we can introduce that to all of our customers and to our agent partners and help them sell something incremental. And then our third is within our agent community. So GlobalTranz is 45% of our revenue is driven by our agent community, and many of our agents over time want to have something where they want to retire, they want to move into something different or take advantage of the bigger resources of GlobalTranz. So we also do agent acquisition. So 3 different tiers, but for each of those, we're thoughtful. Certainly we have metrics and things that we look at for acquisitions that are important to us. And customer is one of the most important things that we look at our customers, our carrier partners, and make sure this deal works from that perspective as well.
So the fund we're operating out of is $750 million. So it would definitely be a stretch to say we have unlimited access to capital. But we have a great partner, and it is tremendously beneficial to have the backing of smart money. Folks who do this for a living, they know how the process works. They know how to help you think about the potential returns, how to structure any leverage that you're taking on. A company the size of Redwood isn't staffed to really do a thorough job of, sourcing and vetting acquisitions. And that's where your PE partner can really help you step up and compete in what is right now a very aggressive, seller's market. So they've been a tremendous asset for us. We never could have gotten, 5 to 6 deals done in 2 years without them.
As Renee was talking, I was thinking about the next question, which I didn't circulate earlier, so I hope it doesn't catch anybody by surprise. I'm sure you think about this all the time, though, and it speaks to the whole challenge of integration and how quickly you integrate. What are some of the trials and tribulations associated with integration? Do you try to get it done in 6 months, 18 months, 36 months? And what are some key lessons that you've learned over the years in terms of what decisions to make sure, or at least increase the probability that the acquisition is going to be integrated successfully? Doug, do you want to take a shot at that?
Yeah, it's really simple. It comes down to people, culture, and technology. So you've got to think through how the people, who's going to do what, who's going to call on which accounts, who owns which carrier. You've got all the social dynamics. Then what are the two cultures of the company? How do they blend? How are they different? You've got to have a lot of communications wrapped around that to steer people where you want them to go. And then technology is always a key in this day and age, because in any large company in our space, your process is ingrained in your technology. And you can have the best technology in the world, but there's a little issue that's known as change management. And when people have to do their job differently, I don't care how good your technology is, they think it sucks. So you've got to get people over that hump. When you put them on a new system, you've got to manage the culture and the people.
Interesting. Now, you've done 22 total deals, one of which I would characterize as being transformative. That with Command, which really grew up as a very high-quality truckload broker, And Echo grew up really more as a high-quality LTL broker. Yeah, I don't think I'm simplifying to that big an extent.
I'll correct you in a minute, but go ahead.
Okay. Let's just take that as fact. And when you acquired Command, you sort of removed the truckload module out of your existing system and sort of plugged in the Command module. I would have thought that would have been relatively easy, but it seemed complex as time went on. What did you learn from that process?
Well, at the time that we bought Command in 2015, our revenue as a company was about 1.2 billion. And even though we had the kind of the market identity as an LTL broker, half of our revenue was truckload brokerage. So we had 600 million of truckload brokerage, and when we bought Command, they were about 600 million of truckload brokerage, and then we had another 600 of LTL and managed trans. So we had two like-sized truckload brokers that we put together, and we liked the Command technology better for truckload brokerage. You know, it had the legacy of their founder and his previous experiences, and it just happened that it was written in .NET. Our system was built in .NET, and so we had to basically refactor it into our platform. And there's a lot of wires and pipes you have to hook up to do that, and you have to retrain everybody, you know, because the order entry still happened in the ecosystem, but all of the kind of the data science and matching and digital marketplace functionality for truckload was happening in the Command system. So we had to teach all the Echo people how to use the truckload technology. We had to teach all the Command people how to use the Echo technology. And so it was just a lot more complicated than we thought. We told Wall Street we would get it done in a year, and it took us about 18 months. And you know, like all acquisitions, there's the excitement in the beginning, there's the depths of despair, and then you climb out of it and get back to reality and get back to business. So we learned a lot of lessons, but it was those three things I told you previously. And you know, you've got to, especially with transformational deals, you got to think long and hard about your technology strategy.
Right.
And I know, just real quick for us, I want to add on, we have a full-time PMO. So we have a project manager that runs our integration. She has 2 full-time staff, and then we have people who are assigned to that team to do the integration. So they're running full-time on making sure we're doing that. One thing that I'm proud of, and actually we have a couple of people from acquisitions that we've done, AFN and Circle 8 in the audience today, is that we make sure we look at best of breed solutions. We don't try to come at it and say there's one GlobalTranz way. We know that as we acquire companies, that they have great ideas of things that they've built and things that they've done, and we want that to live on and become a better GlobalTranz. So we've done a nice job of making sure we incorporate in many cases, those leaders take more significant roles across the board at GlobalTranz. That's an important part of our integration. So we have a project plan, we track against it, we make sure that people have significant roles within the organization, because we're really buying talent. We don't buy widgets or make widgets. It's a people business. So Doug, you mentioned people, process, and technology. That's what it is. And when we do our integrations, it's important that we're addressing all those different aspects.
Now, all three of you have some element of organic growth within your companies, adding people, getting more productivity out of each person. That's a part of every healthy company, really. I think, but you're also supplementing that organic growth with acquisitions, most of which are sort of tuck-ins, I would say, and some of which might be more transformational. In dealing with public equity investors or with private equity, do they value organic growth more highly or less highly than M&A driven growth? Can you talk a little bit about that?
Yeah, I mean, I think when we think what we're trying to accomplish, I mean, we're definitely trying to build a company that is capable of sustainable organic growth over the long term. I mean, I think acquisition growth is great, but it's got to position you as a better company, not just a bigger company, right? And so there's absolutely no doubt when we look at acquisition, potential targets, one of the first things we're looking at is what kind of organic growth have they been able to show in a variety of economic conditions. If we can see somebody that grew through 2008, 2009, 2010, we know they've got something that is, well, probably remarkable in that case, but is nonetheless clearly a solid business. So I would say we definitely put a premium on businesses that are capable of organic growth, and it's a big emphasis of us to build and invest in the company so that it's capable of producing that kind of outcome as well.
Yeah, I think public company investors definitely prefer organic growth. If you do acquisitions, they better be accretive. But I think one of the things our investors understand is that, you know, even though we have 22 acquisitions and it might appear that we're buying our growth has really been organic. You know, we bought our very first acquisition in 2007 was a West Coast small regional freight broker that had 18 million of revenue. You know, today that office for us does 175 million in revenue. We bought another broker in Phoenix in 2011 that had 22 million of revenue. You know, today that office does over 200 million in revenue. So we buy these small brokers, we empower them with our technology, we give them additional modes to sell, and we teach them how to sell managed transportation deals, and we essentially teach them how to grow as fast as Echo grows. And it's beneficial for, you know, the owner that's running that location, and it's beneficial for Echo. And although it looks like a lot of M&A growth, it's really organic growth by fueling those companies and teaching them how to grow.
I would agree with that. You know, we look at growth in two ways. One is their track record of their growth. Mark, you mentioned that. So that's important in an acquisition because GlobalTranz is a high growth company and we want to acquire companies that have that same culture, that same mentality. So we're looking at that. And then afterwards, as I mentioned, you know, the couple that we bought in 2017 doubled and tripled in EBITDA. And that's important because, yeah, you want to make sure that you're buying businesses that fit well within the culture, that can use your technology and will continue to sustain that growth, and that becomes organic. So, you know, our investors believe in having that strong organic growth. About 50% of our growth that has come from organic and 50% in technology over the last couple of years. But the company was founded in 2013. It was all organic growth up until 2017. So we've married up both now.
That's awesome. We're getting a little short on time, so I'm going to ask one more question. If there were just two things to look for in an acquisition, what would they be, and why those two things? Mark?
Well, I think I'd echo Renee's comments. I think first and foremost for us is culture, because we have a very unique culture, I think, at Redwood, and it's something that's evolved over a long period of time. And you know, it's very hard to build a culture. It's easy to destroy it. And bringing two cultures that don't get along can be extremely dangerous. And it's also, unfortunately, the hardest thing to sort of quantify in due diligence, whether these teams are going to work together and whether you've got a real cultural fit. So I would say culture first, and then for us, it's the strength of the management team. You know, we want a management team that sort of wants to be part of something bigger, wants to take the next step. If it's a management team that all wants to kind of cash out and retire, that's probably not the deal for us. You know, we want a strong, committed management team.
I have nothing to add to Mark's comments. It's people and culture.
Technology is a distant third? Or?
Well, depending on the size of the deal, but you know, technology is important, but you can figure that out. You can't change the people and you can't change the culture overnight.
How long do you like to lock in the people that come with the business? Is there a period that you think is a minimum?
Forever.
That they stay?
We've got a lot of our early acquisitions, and the owners are still with us as employees. So we really want to buy companies where the owner maybe wants to take some chips off the table, but wants to be part of something bigger, and wants to be part of our culture and part of our family. And when that's their motivation, it works really well.
Anything else to add, Renee?
Just that high growth mentality, I think that's part of culture, and the whole culture that we have of ready to take it to the next level, it has been great. And then we also have give back to the community, do the right thing by our customers, have great partnerships with our carriers. That's all part of who we are, and so we look for that in an acquisition as well.
Well, we're just about out of time here. We've been very fortunate today to have really three of the leaders in the transportation and logistics asset-light world. Mark Yeager from Redwood, Doug Waggoner from Echo, and Renee Krug from GlobalTranz. They're all building great companies and I think you're going to be surviving even the digital freight brokers. Maybe you'll become digital freight brokers yourselves.
We are.
There's this perception that the existing brokerages don't have big technology workforces, but I know all three of these companies have very large groups and are trying to keep pace with the latest developments in the industry. So we expect when Transparency19 takes place in 5 years that you'll still be here and have some very interesting comments to share with us. So thanks again for coming out today, and big round of applause for our panelists.